Absolutely. Hi, Robin. How are you?
I'm good. Good, thank you.
Great. Good to see you. Okay, fantastic. We'll get started. We should get started now. We're already live. Okay, good morning, everybody. I'd like to welcome you all to the Daily Energy Markets podcast. It is Friday, May the 19th. I'm delighted to be joined by Robin Mills, CEO of Commodities, Yusuf Al-Shamari, CEO and Head of Oil Research at Sea Markets and Senior Research Fellow at Imperial College London, and Clyde Russell, Asia Commodities and Energy Columnist at Thomson Reuters. Thanks so much, everybody, for joining us, and also to our viewers. Robin, let me start with you. Give us your take today as we sort of wind through the second quarter on these differing views on demand that are still out there. You know, of course, nobody can tell, but the uncertainty on demand and where that might be going in the second half of the year, particularly, of course, on China's direction, and of course, how that might impact producer policies as they stand today.
Well, yes, thank you, Diana. It's been, the past 4 weeks been really a bit of a confusing time. I think, if it was in a very pessimistic kind of macro view, and that to me has been overwhelming the, more generally positive, both supply and demand signals. Now, perhaps, I wonder if we're getting through that. We saw a bit more optimism on this US debt ceiling. It seems over the past 4 weeks, there's always been a topic of concern about the economy, whether it's the debt ceiling or bank failures or interest rate rises. There's always some issue. I wonder if we're now getting through that period, assuming indeed the debt ceiling is resolved. And demand continues to be a big question mark, and we've seen, as usual, the just confusions over the data. We saw those significant revisions on China by the IEA, that go back years. That's a perennial problem. But it does seem the demand picture on China is actually reasonably strong, and the US picture, at least on the gasoline side, is strong too. And we've probably reached an all-time high in oil consumption last month. So that I suppose would finally draw a line under the COVID period. That ought to be supportive in when set against the supply picture as well. As long as demand does remain reasonably robust, then the fundamentals look fairly good. And I think people have said this. You look in the second half of the year when supply is probably falling short. We probably also saw a deficit in March, and that's a bit cloudy because of what's really going on with Russian exports. But if there's a deficit in March, that does set the stage for more of a deficit later in the year, which has been foreseen for some time.
Okay, thanks, Robin. Clyde, on that front of the slightly more possibly positive outlook of demand to come, and looking at the balances of supply and demand, we're still not seeing that sort of tightness scenario being reflected in prices, are we really? There's still, despite the OPEC cuts, despite the fact that we're expecting stronger demand, we haven't really seen that boost to the floor of prices much in the last week or two. Would you agree with that? What will it take, do you think, to get us back into the 80s?
Well, it's interesting because all the things that we're talking about, the boost to demand, hasn't really happened yet. The OPEC supply cuts haven't really happened yet. So, we're sort of in that interim period waiting to see if this actually all comes together. We're expecting the IEA, I think, is actually probably now on the very optimistic side for China demand growth this year. We have seen some growth in imports in China, but I always think that people tend to ignore they only look at one aspect of one piece of the puzzle, which is what are Chinese imports doing? Well, they were weak in April, let's be honest. They're going to recover in May. But, you've got to actually look at how the Chinese do things. Yes, the refinery processing was really strong in April. That's a good positive demand signal because it shows that their domestic demand is really actually starting to rise. But the Chinese didn't actually, they didn't necessarily import anymore. That's probably because they arranged the cargoes several months in advance and they decided to run the refineries harder than they had expected to in April. But they did dip into inventories for the first time since November 2021. That's an 18-month gap where they built inventories every month, albeit in small amounts, and now they actually dipped into them. So what you're actually really saying is that the Chinese can respond to domestic demand growth by dipping into inventories. They don't necessarily have to import anymore. So whether they import more is always going to be a price thing. So if the price remains sort of anchored around the $75, $80 a barrel, I expect the Chinese will import more. But if it goes back up to 100, then they'll dip into inventories again, because they'll say $100 oil is not appropriate for the world's current economic conditions.
Okay, thanks, Clyde. And I'll go back to you on the domestic sort of product demand in China and see where those sort of variances are. Yusuf, welcome again. Given, that Clyde just said, we haven't seen the OPEC cuts, recent ones come to the fore. We've got a meeting in 2 weeks' time. Prices are still not really where OPEC would want them to be. And it has quite positive forecasts for demand in the second half, OPEC at least does, along with the IEA. So Yusuf, where do you think that group stands today now in terms of forward looking from now to the end of the year? Do you think they're going to definitely wait December to act again, or are they, a little bit nervous about the fact that prices are not yet really where they would ideally like them to be?
Hello, Diana, and good morning, everybody. It's very hard to predict the next action to be taken by OPEC Plus. We've seen these voluntary cuts taking place in April, and the reason that they have not been enforced this month yet is, as you know, for example, in the case of Saudi Arabia, Saudi Aramco completes its contract ahead of time, so the cargoes to be shipped in May have already been agreed with refiners. So that's why there will be, yes, a production cut, but export-wise, for example, in Saudi Arabia will not be affected for the month of May. But I would expect we're going to see less exports coming after May, starting from June till the end of the year. Now, what they have, the group definitely, yes, they have a meeting in June. And honestly, I wouldn't expect that they will make further cuts at this stage. Why? Because we're currently seeing the market is somehow it's kind of improving. The conditions are improving, and the reason is, as we know, the biggest hit that the market has had since the OPEC voluntary cuts is the U.S. financial crisis. Whether it's the banking crisis or an agreement between Congress and the White House on the debt ceiling. But now, as we hear from the news, there is some improvement in the negotiations, and I suspect if these negotiations continue to improve, that will be positively impacted on the market, and we could see prices going back to $80. That's why I would expect OPEC Plus to remain and a bit patient for prices to improve. Certainly, if the market would have is expected to take a further deterioration in terms of prices going to less than $70, then I would expect them to make further cuts in later this year. That's the first thing. The second thing is the SPR. So we're expecting the Biden administration to start refilling strategic petroleum reserves, and that could improve the market conditions a little bit, moving from now till mid or the first half of this year. China's demand, I wouldn't expect it will change much, but the current weakness now is on diesel and in the industrial sector. But on the jet fuel, which is the largest growth expected this year, the demand figures are quite strong. So I would expect OPEC. These are, let's say, some of the optimistic views that I would expect OPEC Plus to remain with its policy for the remaining part of this year. Okay,
thanks, Yusuf. Robin, back to you on that. In terms of OPEC, would you agree with Yusuf, regardless, that they will sort of hold their ground at least for the next month or two? And Russian production, how much is that impacting OPEC's thinking these days going forward? Obviously, it's part of the OPEC Plus group. It's in a war with Ukraine. It's doing whatever it wants. What's the feeling amongst the group there of how much they can let sort of Russia do what it likes and even not take into account, what Russian production is doing to that extent?
Well, the issue of Russian production is absolutely crucial to Russia's credibility, I think. Russia announced these kind of unilateral cuts, and there's a question mark. Well, is this a tactical move, or is it genuinely Russia having trouble selling these barrels? but we've actually, as you know, as we've said, not really seen Russia following through on that. You know, Russian exports have remained quite high, and that, I think, that goes back to the issue of credibility, and that also has an impact on the behaviour of the rest of OPEC plus. If they see Russia promising to cut and not cutting, and of course OPEC plus, the leading members of OPEC plus announced their own cuts in response to the Russian cuts, or at least following the Russian cuts. If Russia doesn't follow through, there definitely won't be any impact on any appetite from the rest of OPEC plus to make further cuts. So we do need to see how the OPEC plus cuts filter through. You know, I'd expect that the compliance elsewhere will be high. We'd expect Saudi and the UAE and so on to comply pretty fully, as they have done previously. Iraq is complying for, you know, whether voluntary or forced reasons because of the shutdown of the Turkey pipeline, but in any case, it's actually over complying for now. You know, Nigeria is down anyway for other reasons. So overall compliance to this latest round of cuts will be good, but there will be a look at, okay, is Russia really following through, and does the rest of OPEC plus want to make further cuts, and maybe Russia promises something that it then doesn't deliver.
Okay, Clyde, just back to you on China, and let's just look a bit about products. Yusuf referred to diesel demand in China. That's not quite where maybe people thought it might be by now, industrial use. Jet fuel demand also, there's been comments that domestic travel's improved, but we really haven't seen yet this sort of international aviation demand on China, if you like, or from China, filter through. Where are we there in terms of the various products in the barrel? And what's the latest on products exports out of China and quotas there for Q3 going forward?
Right. I think the standout is jet fuel, and it is currently a domestic driven thing in China. People are getting back on planes. I would expect that will remain quite strong. And I also expect to get a boost as China reopens to the rest of the world. Chinese tourists are very dedicated travelers around Asia, and, you know, they'll be wanting to get back out again. And other countries have kind of opened up to China now, so, you know, it's back on the menu. They can come to Australia, they can go to Japan. It's that sort of thing is happening. So that jet fuel is looking quite positive. Gasoline is also fairly positive in China, again, as people get in their cars and drive again. They're going back to the office, they're going to visit friends and relatives, that sort of thing. The concerning one is diesel, and that really is a reflection of weaker industrial demand, less demand for transport, less demand for construction. So, you know, it's very hard for me to construct an overall bullish thing when I still see diesel being weak. And I also see that diesel's weakening, and not just it's not weakening in China, it's just not strong growth, but it is getting weaker in other parts of the world. And that, you know, while I recognize you've got like sentiment drivers, if we get a debt ceiling resolution in America, all the actual real activity data seems to be trending the other way. And that, you know, it's very hard to say, oh, we're going to have a bullish oil result if, you know, Western Europe is going down, the US is going down, and Asia's spluttering along, which is what's currently happening as far as diesel is concerned. So I think that's quite interesting. What is on the Chinese product exports? They went gangbusters in the first quarter. They were up almost 60%, concentrated largely in diesel because the margins were fantastic at that time. And so the Chinese exporters, refiners, asked for and got quotas. It's always a very easy, quick economic win for Beijing as well. If you want to boost growth quickly, that's an easy way to do it. You've got the refining capacity, just run the refineries harder, export the products, make money. Wonderful. But, you know, their second round of export quotas was only half what they gave in the first round. So that implies that from like May onwards, we're going to see quite a sharp fall in Chinese product exports. That doesn't necessarily mean they won't buy more crude oil. That will now be driven by their domestic demand situation. But I do expect that their exports will taper off.
Okay, and Clyde, just sticking with you quickly on in terms of sort of gauging Chinese economy activity, what about other commodities, you know, metals, etc., that are going into other products, if you like, and that's impacted, as you said, by the Western demand? Are we seeing any revamp or indicators there in copper and other metals, etc., which would give us a sort of forward-looking view on that?
Iron ore is probably the one that I look at most. It's quite key for the construction sector. And it went gangbusters in the first quarter and then is kind of like slowed down quite sharply in April. And I'm expecting a sort of similar sort of result this month in May. That's really because the steel mills, I think, anticipated stronger demand for steel than they actually got. I mean, it has been rising, but it wasn't quite rising at the rate that they were producing extra steel. So you've seen Chinese appetite for iron ore imports taper off a bit. You've seen the price come down a bit. On copper, a lot of the flow of refined copper into China is actually driven by, is there an arbitrage gap with London prices? So what you've really seen is there was an arbitrage gap, so copper flowed from the rest of the world into China, and it's basically been stored. So you've seen LME copper industries, inventories drop, and you've seen the inventories in China rise. So that's kind of that kind of flow. There's not really a fundamental demand, explosion for copper in China, but they have been importing somewhat more. The standout commodity is coal, but that's really a reflection of the fact that they didn't have hydro generation and that seaborne coal prices were cheaper than domestic coal prices. So that it was an economically driven thing. Now that Chinese domestic coal prices are coming back down again, I expect that seaborne imports will tend to slip a little bit. But overall, China had a very strong start to the year in virtually every commodity. And we've basically seen in the last couple of months, May and April, that this is basically tapered away.
Okay, thanks, Clyde. Yusuf, just back to you and talking a bit about Russian supply and how that's being routed through and also making a stop in the Gulf for processing, etc., reblended, re-exported, let's say, back to Europe or onto Asia. Any indicators there that you're aware of if we're seeing that continue to trickle through here? Are we seeing increased volumes of Russian crude being sort of blended and re-exported? And what's the outlook going forward for that?
Well, currently, most of the Russian oil is being exported to China and India. And I think my colleague Clyde from Thomson Reuters, perhaps they also have some accurate data on that. But what's happening is that we've seen the increase or the increments in terms of importing more supplies from Russia by China and India has been in my view, has taken an economic advantage. Why? Because now we're seeing, as one might expect, there's taking a share from of that crude coming from the Gulf, from Saudi Arabia and other GCC countries, and even members of OPEC. But I wouldn't expect that to be a concern because, for example, in the case of Saudi Aramco, they have long-term contracts with China and India and as a bulk supplier. So that supply coming from Russia is, in my view, is a temporary basis. So that oil, what we see now with the refining margins from in India and China are at their highest levels for decades. And the reason is the huge discounts offered on Russian oil and re-exporting that to international markets, including Europe. But for how long that would expect it to continue? Well, I would expect as long as the wars continue between Russia and Ukraine, then Russia would need some form of finance. And the best place will be India and China. So I wouldn't expect the situation to change much for the meantime.
Yeah, I mean, Robin, is Russian crude displacing any Gulf crude really to China? It isn't. It's displacing more West Atlantic, isn't it? North Atlantic crudes, etc. There doesn't seem to be any concerns there from Gulf producers, even as we go forward with more Russian supply. It's displacing other sources, isn't it, rather than any Gulf crude into China.
Yes, but pretty much on balance. Look, I think the real concern is over India, the displacement in India rather than China. And we're looking at India, which imported virtually no Russian oil prior to the war, and now has become a very major importer of Russian oil. India is probably reaching its ceiling, how much Russian oil technically it can run. I think that if the war and the sanctions continue, then Indian refiners will look at technical upgrades to see if they can stretch the amount of Russian crude that they run even further. That's been a difficult question, because if this was a temporary situation, of course, you wouldn't want to make those upgrades. If you think this is going to be a near permanent feature of the oil market, then it starts making much more sense. And then I think, and Yusuf mentions the long-term contracts, of course, from for Gulf crude into China and India. Those are important, of course. But then again, if the war drags on and sanctions drag on, then again, the refiners will have to take a look at, do we believe this is a long-term feature of the oil market, and do we want to scale back on our long-term contracts from the Middle East and treat Russian crude more as baseload? So those are important things to watch, and no immediate prospect for an end to the war or an end to the sanctions, and even then you'd question, would Europe ever go back to being a major buyer of Russian oil?
Yeah, certainly, probably not. There's the survey question of today, which is a price question for everyone today. What will the average be in the second half of the year for Brent crude as things stand today? What do we think? Are we going to see that range, 65.75, 75.85, or above 85 average price for the second half of the year? I'm not sure what the average has been for the first half so far, but it's probably somewhere there in the middle. So presumably we're going up in the second half of the year. Clyde, just to go back to you a little bit and talk about India, because India has been obviously a big, a booming sort of economy this year. It's not struggling at all with the oil price where it's been by all accounts. How much impact is our Russian flows sort of having on India, if you like, on Indian growth, the Indian economy? Tomorrow, if Russia cut off its supplies, where would India be in terms of replacing what it's been taking in the last few months?
Well, it's fascinating. I mean, India, as Yusuf said, they took virtually no Russian crude prior to the war. Now it's almost 40% of their mix. It's actually the same level as the whole of the Gulf, the Saudis, the Emiratis, the Kuwaitis, all together. So that's kind of an enormous step change in the way Indian refiners have been doing this. I mean, obviously they're taking it for the discount. Estimates vary because it's getting quite a dark trade now to just get exact handle, but it seems like they're landing the crude on the west coast of India at those big refineries like Jamnagar for about $10 a barrel below what they can get landed crude from the Middle East at. So for them, that's a massive incentive for this to continue. And as long as they are allowed to, in the sense that the Western world says this trade is fine, we're happy with it, which is so far the case, then I expect this will continue. If they were suddenly to lose all that Russian oil, then they'd have to go basically begging back to their suppliers in the Middle East and say, yeah, well, can we get some more? But I don't see any reason for that to happen at the moment. The Russians have a very limited marketplace where they can now sell their crude. And if it wasn't for China and India, they would be in deep trouble. So as long as India takes all the sort of Baltic West crude or from Russia's west, and China basically soaks up all the Pacific crude, they're all going to be happy. And quite frankly, the Western powers are happy too, because it is being sold at a lesser price. It is cutting the revenue that Putin is getting. And they don't really care that, some dodgy middlemen and tanker people and fly-by-night insurance companies are now making more money. As long as Putin's getting less, they're happy. Where there might become an issue is if countries start to say, oh, well, we don't really want to buy products from India because, it's Russian crude. I'm fairly certain I can track, I know I can track Russian crude going into India, products coming out, cycling through Singapore, and then landing up here in Australia. It's quite likely that my diesel SUV is powered by Putin's crude. But, so far that seems to be acceptable.
That's been okay. Yusuf, where are we with Iranian production these days and exports? It's kind of a little bit off the radar in the news, but we seem to have some more positive figures being put out there in the last month or so about Iranian exports and production. But are we really seeing any significant change there?
There is an increase in Iranian production, but I would expect by about 160,000 barrels. You used to see it around 2.5 million barrels. Now it's about 2.65 million barrels. And I would expect there's even a much bigger increase on the black market, the figures that we don't see. And there's some analysis has been suggesting that this could have been also made an impact on the recent decline in prices. But Iran has always been selling its oil in black or gray markets, especially to China. So that is not something very new in my view. We've seen that since since even President Trump time now through Biden, because since the sanctions have actually been put into place. But now what I'm interested just to see is how the level of Iranian production will change after Saudi Arabia now has signed a peace deal with Iran. Will we see a change in terms of the sanctions level being placed on Iran? Will their production increase in the years ahead? As we all know, Iran is an important member of OPEC, is a founding member of OPEC. So will we see a change in the years coming ahead? I would just keep an eye on that as we move in the years ahead.
Okay, well, obviously that depends partly, Robin, on the US talks with the nuclear deal, etc., which seems to be sort of been shelved now, certainly from the US domestic point of view. Where are we with that? Do you think if we look at a 6-month forward, are we going to see that discussion publicly raised again, or does everyone have other priorities? But given the Saudi-Iranian rapprochement, nuclear concerns in the Gulf, where are we at with that deal now and those negotiations and talks?
Well, I always call the Saudi-Iran deal a détente rather than a rapprochement. I mean, there's not a great meeting of minds here, and the two countries are certainly not friends. They're just not as hostile as they have been, and they've agreed to set certain parameters on their rivalry, which cool down the temperature in the Gulf, which is a positive thing. Yeah, look, I think as far as the US nuclear deal is concerned, I have very little hope for a revival of that in any form. Certainly before the next US presidential elections. Doesn't seem to be any momentum. As long as Iranian production is up a bit, and indeed it is, and exports are up, economic pressure is eased a bit, then the Iranians don't have to come to the table as urgently as they had to before. And meanwhile, domestic politics in the US really don't align but behind any deal. Now, yes, the levels of enrichment are going up. Iranian nuclear activity is going up. That's certainly a problem to keep a very close eye on. And in case at some point the US and Israel feel they're compelled to take some further action. But again, I think the Saudi deal complicates that and makes a kind of more military action or whatever more tricky. So yeah, I don't see any revival of the deal. I just see, as we've seen, Iranian exports bounce back a bit and stay at that level. Where we go from here, and I think there's just a long wait until there's some shift in the politics, particularly on the US side, and perhaps depending on the result of the elections, if we see a Republican elected, I'd expect to see a more hostile attitude to Iran. If we saw a Biden second term or another Democrat, then probably is a chance for a bit more momentum. But that's a long way off.
And of course, all to do with and it is the party to do with how Iran is mending relations here in the region, doesn't it? And given Saudi-US relations, it's all a nice complicated circle there. Clyde, as we look at those results on the oil price forecast, it's a safe one right in the middle, where we've been so far, I suppose, I think so far this year. Clyde, just on gas, I mean, not just from Europe's point of view, we've talked a lot about that in the past on this show, but Asia, looking forward, gas prices are quite sort of steady and attractive at the moment compared to when they weren't a few months ago and last year. What would be the Asian outlook? I mean, again, it depends on demand, but if we do see a big boost in demand the second half, how much do you think that will impact Europe's gas or Asia's gas security? We saw Europe taking a lot of the expensive gas last year because it could afford it. So any qualms about that in Asian economies?
Not currently. The sort of spot LNG price is sort of hovering around, multi-month lows. It's well off where it got to last year. We are in that sort of shoulder season where the buying by Japan and South Korea certainly tapers off, in the gap between winter and summer. What has been tending to fill in that gap a little bit is the very price-sensitive buyers in South Asia have been coming back in and taking a few spot cargoes. But if the price, does rise again, if China actually starts buying more LNG, like what it was buying in 2021, then you start to see, and the price starts to rise again. that will just squeeze the South Asian nations out. And if Europe does end up being short of gas, I would fully expect that they'll just pay whatever price in order to draw those cargoes. So at the moment, it's quite a steady market, but it's it's definitely worth keeping an eye on. But it really depends on what the Europeans do.
Yeah, and I mean, Robin, a lot of gas available from the US, presumably, should Europe need it.
Yes, we were. Yeah, we've seen. There's obviously the Freeport plan coming. Repairing its problems after the explosion. Won't see a lot of new US gas until 2025 when the next wave of export plans start coming up. But in that 2025-27 period, yes, a lot of new US supply, and of course at the same time as Qatar and other new producers or expanded producers are coming in. I think there was a view that the price would weaken very significantly from 2025 onwards with this new supply. As Clyde says, of course, we've seen prices weaken in advance of that. Even though, you'd say, look, on a fundamental point of view, the market remains tight and there's certainly great. It's very vulnerable to a period of either high Chinese demand or cold weather in Europe or some other demand-related factor. But for now, European gas demand is down significantly, and I expect that to continue. There's obviously a big push in the EU for efficiency gains and for more renewables and so on.
Yeah, efficiency certainly, but they've also improved their infrastructure a lot. They've gone more LNG should they need it. So that capacity, I suppose, has improved there. Yusuf, just one last word for you. How did you vote on that survey question? Where do you think prices will average in the second
Well,
half?
I was in the middle between 75 and 85.
Okay, that's too safe. Maybe we shouldn't.
So it seems that most of the answers were that.
Yeah, it would take a lot to get us above 85 for an average. Gentlemen, thanks so much for joining us. Robin Mills, Yusuf Al-Shamari, and Clyde Russell this morning on the Daily Energy Markets podcast. Have a great weekend.
Thank you.
Thank you.
All the best.
Thank you, guys. Nice to see you.